The Latin American and Caribbean property market is headed for another year of declining prices, and industry insiders say there's no end in sight to this downward spiral that's reshaping the entire regional insurance landscape. Brace yourself for 2026. The relentless downward pressure on property insurance pricing across Latin America and the Caribbean shows zero signs of slowing down. In fact, seasoned Miami-based reinsurance professionals are predicting that not only will prices continue their steep descent, but the very terms and conditions of insurance contracts could face dramatic overhauls, assuming the region manages to dodge any catastrophic losses this year. These sobering predictions emerged from candid conversations with multiple reinsurance underwriting and broking executives operating out of Miami's insurance hub. These industry veterans have been closely monitoring the mid-year renewal season, which witnessed an unprecedented surge in competition that's fundamentally altering how business gets done in the region. But here's where it gets controversial. This pricing freefall represents a complete reversal from the dramatic market correction and significant price increases that dominated the landscape from 2022 through 2023 and beyond. What we're witnessing now is essentially the market swinging from one extreme to another, and some experts are questioning whether this pendulum swing might be going too far. Simultaneously, insurance companies have been aggressively updating their terms and conditions, with particular emphasis on what industry insiders call attachment points, essentially the threshold at which coverage kicks in. These attachment points have skyrocketed in many cases, meaning clients must absorb more losses before their insurance coverage begins to pay out. As we look toward 2026, industry expectations point to sustained downward pressure on pricing, fueled by an increasingly crowded competitive landscape that's forcing insurers to slash rates just to maintain market share. The high-stakes waiting game. Want proof of just how dramatic this pricing pressure has become? A senior executive from a major international reinsurer, speaking from their Miami headquarters, pointed to a telling phenomenon during the final 72 hours leading up to the critical July 1st renewal deadline. According to this industry insider, clients who played a dangerous waiting game, holding out until the absolute last moment to finalize their mid-year renewals, were handsomely rewarded with significantly better deals. This nail-biting strategy of brinkmanship is becoming the new normal, and it reveals just how desperate insurers have become to secure business. I don't see that changing anytime soon, the executive revealed. There will be a discussion on rates, that's without a doubt, and we have some room on rates. This admission essentially confirms that insurers are prepared to continue cutting prices to remain competitive. But here's the part most people miss. While the industry has successfully absorbed and adapted to the dramatic changes in terms and conditions, particularly those elevated attachment points, this executive believes it's only a matter of time before these contract terms also come under intense pressure, provided the market continues generating profits. The executive made a bold prediction that's sure to spark debate. They're not going to go back to where they were 3 or 4 years ago, but there's going to be pressure on attachment points. This suggests that the pendulum might swing back toward more favorable terms for buyers, potentially undermining the risk management improvements that insurers fought so hard to implement. Another Miami-based reinsurance broking source painted an even more striking picture of the current market dynamics. They revealed that major reinsurance companies are essentially waving the white flag on pricing battles, with industry giants openly telling clients that their primary objective is simply maintaining their existing market shares rather than maximizing profits per policy. The big players here in the Miami reinsurance market have been telling clients that their main concern is to maintain their shares and that price is not going to be an issue, the source disclosed. This represents a fundamental shift in business strategy that prioritizes volume over margin, and this is the part most people miss. Established insurers are desperately trying to expand their participation in existing programs to offset declining rates with increased premium volume. However, they're facing intense pressure from an unexpected source. New competitors flooding in from Eastern Europe and the Far East regions that weren't traditionally major players in the Latin American market. Extremely transactional mindset. The reinsurance broking executive delivered a particularly candid assessment of client behavior that might ruffle some feathers. Buyers in this part of the world are extremely transactional, so they will focus on pricing substantially, and I don't foresee a battle around terms and conditions of contracts or anything like that. This characterization of Latin American and Caribbean buyers as purely price-focused raises interesting questions about whether this transactional approach might be short-sighted. Are clients potentially sacrificing important coverage protections for immediate cost savings? Another broker corroborated this view, explaining that most clients have essentially surrendered to the contract wording changes and exclusions that have been imposed over recent years. Most will focus more on pricing because there is margin there for reinsurers to cut, they observed. But here's where it gets controversial. This same broker predicted a dramatic shift once insurers reach their breaking point. Once they reach a point where there is not enough margin to cut, then the negotiations on terms and conditions will start, they warned. This suggests that the current peace on contract terms might be temporary, setting the stage for future battles. These insights emerge against a backdrop of dramatically improved conditions for insurance buyers during recent renewal cycles. After reaching what many consider unsustainable peaks in 2024, Latin American and Caribbean property catastrophe pricing began its downward trajectory at the start of 2025, driven by what industry analysts describe as an abundance of capacity, essentially, too many insurers chasing too little business. Ample capacity creates buyer's market. The mid-year renewal season provided compelling evidence of this capacity surplus. According to Aon's comprehensive reinsurance market dynamics mid-year renewal report, Latin American and Caribbean reinsurance capacity was broadly sufficient to ample, having grown over the past year. In layman's terms, there were more than enough insurers willing to write business, creating ideal conditions for buyers to negotiate favorable terms. This capacity abundance stemmed from increased appetite among traditional treaty reinsurers, companies that provide insurance to insurance companies, particularly for proportional coverages where they share both premiums and losses on a percentage basis. This heightened competition created a feeding frenzy during renewal negotiations. But the competition didn't stop there. Aon noted that the facultative reinsurance market, which provides coverage for specific individual risks rather than entire portfolios, also joined the competitive fray. These facultative players deployed their capacity either to supplement existing treaty arrangements or to cover risks that traditional treaty writers found unappetizing. Interestingly, while reinsurers demonstrated increased enthusiasm for deploying capacity in the Latin American and Caribbean region, demand from buyers was generally stable at mid-year renewals, according to Aon. This supply-demand imbalance created the perfect storm for continued price reductions. Gallagher Re's analysis reinforced these observations, confirming that the softening trend that began in January and continued through April maintained its momentum during the crucial mid-year renewals. The firm reported that cedants across the region have benefited from some increased availability of capacity and reinsurers' appetite to expand their programs. For beginners, cedants are insurance companies that purchase reinsurance to protect themselves from large losses. However, Gallagher Re introduced an important nuance that highlights the complexity of regional market dynamics. The extent of these discounts remains closely linked to supply-demand dynamics. Countries and regions with peak catastrophe exposure saw more modest reductions, while non-peak markets benefited from more favorable pricing. This geographic variation raises thought-provoking questions. Is the market appropriately pricing catastrophe risk, or are insurers potentially underpricing high-risk areas in their desperation to maintain market share? The Tom Wakefield-led reinsurance broker noted that the abundance of treaty capacity empowered cedants throughout the Latin American and Caribbean region to pursue more aggressive growth strategies. These companies successfully filled gaps in their expiring property proportional placements, leading to what Gallagher Re described as more confident underwriting and portfolio expansion. facultative market becomes increasingly buyer-friendly. The facultative coverage sector tells an equally compelling story of market transformation. Aon reported that this specialized segment became increasingly favorable for LAC-based buyers at mid-year as reinsurers' expanded appetite created further opportunities to use the specialist protection to support their growth and manage the volatility within their portfolios. The facultative market witnessed its own capacity expansion as new players entered the arena and established international players broadened their regional footprint as part of comprehensive growth initiatives. Aon also highlighted growing interest for facilities backed by facultative reinsurance as well as hybrid solutions, indicating continued innovation in coverage structures. Gallagher Re characterized the facultative market in the Latin American and Caribbean region as increasingly dynamic during the mid-year renewals, with traditional facultative reinsurers competing head-to-head with a growing number of managing general agents, MGAs, specialized intermediaries that have underwriting authority from insurers. With many of these players pursuing aggressive growth strategies, a softening of original rates has been seen across the region. Gallagher Re concluded, but here's the million-dollar question that's dividing industry experts. Is this pricing war sustainable, or are we witnessing the build-up to another market correction that could leave both insurers and policyholders worse off than before? Some veterans argue that this cycle of extreme pricing volatility, from the sharp increases of 2022 to 2023 to the current dramatic decreases, suggests an immature market that hasn't found its equilibrium. Others contend that increased competition and capacity should naturally lead to lower prices, benefiting consumers. What's your take on this unfolding situation? Do you think the aggressive pricing competition we're seeing in the Latin American and Caribbean insurance market represents healthy market dynamics? Or are we potentially setting ourselves up for another painful correction when the next major catastrophe strikes? Are buyers being smart by focusing purely on price, or are they potentially sacrificing crucial coverage protections for short-term savings? Share your thoughts and experiences, whether you agree or disagree with the industry's current trajectory.